Welcome, everybody. SF Live. We're here in Vancouver at the studio, and I'm joined by Gary Wagner. Gary, executive producer, publisher at the Gold Forecast, and I'm so happy to see you in person. Thanks for coming to the studio.
Thank you so much. It's an honor to actually sit across the table rather than doing a virtual interview and look at someone in the face and break bread, so to speak. Awesome. I'm happy to be here.
Like, I've noticed, like, all my interviews are much longer when I do them in person, so I'll try to keep an eye on the time. But because we have different energy, just instead of just going it through Zoom, it's so much more fun.
Absolutely.
No, and you made the trip from all the way from Honolulu out here to Vancouver, and made it here to the studio. It's fantastic.
Absolutely. My pleasure.
Gary, we got lots to talk about. It's been a while since you've been on SF Live. Mm-hmm. Lots has happened in the gold market. I want to talk to you about also what you're presenting on tomorrow. You're hosting a workshop at the conference. Right. But why don't we start sort of mid-March? It feels like that's when things sort of changed. Fed rate hike, the first one, 25 basis points, a mild one, but it changed everything in the junior mining space, it seems.
Right.
Financing window is nailed shut, pretty much bolted shut, nailed shut, and somebody put bricks in front of it too. What has changed on the gold on the gold side in particular?
Well, March was absolutely a pivotal month, and if we go back to say the previous March before that, 2020, that's when the COVID-19 was first recognized as a pandemic, and that's when the Federal Reserve held an emergency meeting. And what did they do? They dropped interest rates to 0 to 25 basis points. First time they've done that kind of a drop. And they started that fun program that they like to call quantitative easing. In other words, spending a lot of money. The interesting thing is between March 2020 and about 4 months later, even though they're at $8.9 trillion in terms of their assets right now, they started at about 3.7. That was from carryover from the last time they did that, and they jumped that up by about 3 trillion very, very quickly. Now let's jump ahead to March, as you say, and so for the first time since 2018, they actually had a rate hike. Not a big one. We were sitting 0 to 25 basis point, and they went to 25 to 50. Woo! But it was a rate hike. Now, prior to that, they started tapering their purchases because they had, I wish myself or my wife, my significant other, had the kind of budget they had. Hey, spend only $120 billion per month, and listen, don't buy more than $40 billion in mortgage-backed securities, and let's be safe. Let's spend $80 billion in treasuries. And that went on for a long period of time till it swelled to the level I just mentioned. And so they started the tapering process. I think that was back in November, prior to March, because they weren't going to raise rates while they were still buying stuff. So they went to net zero with a huge balance sheet, mind you, and then they actually jumped interest up. Now, the actual rate hike itself was significant that they did something, but in terms of that big picture, wasn't really. It was business as usual. And yet we saw this tremendous kind of like a knee-jerk reaction, especially with corporations. Stock markets started selling off. My take is that U.S. corporations became addicted, literally, to free money. And so they were going through withdrawal pains. Even though it only lessened their cost of doing business, we're not talking about going from 0 to 6% or 0 to 3%. That slight 0.25% really, they were having tremors. They were shaking, and that's what we saw was that reaction, not so much to the level they raised it to, but the possibility that they were going to begin to normalize interest rates, which is a quandary that they're in now. And so that was the dynamic change. And we saw the high in gold, in fact, hit $10 shy of the record high 2088. In March of this year, it went to 2078, and it never looked higher than that. It has been steadily ticking down. And so that was, as you say, March was that pivotal month because it began, not because it went to any significant level. And that's what we were talking about pre-show. Well, what level do they have to go to actually do something about inflation? Because that's what they're trying to do. So that's my take on it.
Yeah, interesting. Like lots of stuff happening, and as you said, gold to 2078, and then it started trickling down. We're trading 1810 or so roughly today, down a couple points again today. So it's been 4 weeks in a decline.
Right.
But not much happened since. Like interest has completely disappeared in gold. Why is that? Like, and where's the interest gone? Like FC dollar index extremely strong. Is the US dollar taking all the attention away? Bonds are rallying. Like interest on or yields on bonds. Like where did the interest go now? Like where did the panic crowds go?
Yeah. Well, my take on it is market sentiment is a fickle finger. I mean, it's always looking forward. So if you see a stock going down, it's because the belief by traders and investors are that between now and 6 months from now, this is what's going to happen. So they're forward thinking. The fact that rates began to rise, real interest rates, not by much, was significant in that it gave the public a sense that, okay, now they're really going to start to ratchet higher. And that's why we saw yields on bonds and notes, U.S. bonds and notes, really move up ahead of anything the Fed did. They hit 3%, I believe, like with the bonds, notes like 2.5%. And this was when Fed funds rate went from, let's call it 25 basis points to 50 basis points. The big shocker was that the Federal Reserve announcer Powell said, look, a 0.75% interest rate hike at the next FOMC, that's off the table. But we do believe that a couple or a series of 0.5% rate hikes in June and July are very possible. So he opened the door for the first time that said, look, we're going to have this isn't going to be a one and done scenario. We're going to raise it 0.5%. And I believe there's 6 more FOMC meetings this year, and they'll probably raise them 0.5%, at least 4 or 5 of them. Of course, now when the CPI came out, what was last week, it actually ticked down to 8.3%. It was at 8.5, but the expectations, the forecasts were 8.1. So the fact that it came in above expectations really sent the market on a tail. And we've seen equity sell off for 6 consecutive weeks, gold for the last 4 consecutive weeks. So it's forward thinking, but the question that we spoke about before, and the most important question is, if the purpose of raising rates and having an interest rate normalization is to stave off the spiraling level of inflation, they're comparing it, rightfully so, to 1982. It's the last time we had this level of inflation, yet back then it was much higher and the circumstances were entirely different. They were based on oil then more than now, and this was a series of events that kind of coalesced together. It was, people talk about black swans. This was a pond filled with black swans. I mean, literally, it was one after the other. I mean, first we get through the pandemic. Now we've got a recession to deal with. Well, is it over? Yeah, it's finally over. Nope, not just yet. Then we have, February 24th, we have the attack by Russia into Ukraine. And guess what? Russia supplies 30% of the oil to the free world. And the majority, a lot of the oil, as you know, especially in Germany, is to Europe. Yeah. And so we come out and boycott their oil, and they're still selling to India and China. But guess what? They decide, okay, we're going to do it. We're going to reverse it. We're not going to sell it to you. And so they're trying to kind of really put the pressure on because it's a necessary commodity for survival. And so we have an entirely different scenario. And then the other black swan was China, which of course never had a COVID, All of a sudden they started to shut down cities, Shanghai being the first. And that's where a vast majority of goods are shipped to the United States and Europe. So what started as a supply chain issue, we had originally as the pandemic turned into a recession and then kind of worked itself out through time and many, like myself, thought, okay, I finally not only see light at the end of the tunnel, I see the end of the tunnel. Then all of this pent-up demand created extreme inflation because now everybody wanted stuff, but they couldn't produce it or ship it fast enough. And that's the problem. And that's the problem we're facing now. And now it's still that combination of supply chain issues along with the geopolitical uncertainty, which are the dynamics fueling inflation levels where they are. And so the question becomes, what needs to be done to abate it? And that's the million-dollar question that's difficult to answer.
Yeah, raising the Fed fund rate is not really the answer to it. And we briefly talked beforehand, like when I look at CPI numbers, it doesn't really include what the Fed fund rate really impacts. And I was looking at mortgage rates and things like that. That's not really part of the inflation scenario.
Right.
House prices and things like that. It doesn't affect that. That's not in the inflation numbers. That's other factors going on.
Well, the Federal Reserve, yeah, their core level doesn't factor in the most important things that are genuinely having the worst bout of inflation, which is energy costs, food costs, and that, don't worry about that, that's transitory. It was maybe 2 months ago when they switched from being transitory to saying, well, it might be a little bit more persistent than we thought. But don't worry, by the end of the year, it'll work itself out. The fact of the matter is they don't have a clue. Yeah. And when I say that, it's not because they're not intelligent. They have every major statistical research group for the government feeding them all these numbers, but they have no control over it. They cannot control supply chain bottlenecks. They can't. And for that reason, they're even worse than stuck between a rock and a hard place. They're grinding to just move around two big boulders.
Yeah. Well, let's come back to gold for a second as well. As like we're trading 1810.
Right.
You mentioned we've traded up to 2078. That's a drop of $270, $280. How significant is that? Like, how does that? Like, it looks very bad. But for me, it's like I looked at the monthly chart over the last 10 years. I think we're holding up great in gold. Like, yes, there's some volatility, obviously, and not everybody's happy with $1,800 gold. But it could be much, much worse looking at the chart. How do you put that into perspective? Like, how does the gold price sort of reflect all of that? Yeah, we've traded down for 4 weeks in a row, but I think we're still golden.
You're dead on. That's an acutely aware observation that not the majority of physical buyers and traders are really considering. Think back. I mean, it was only 2009 or so when we saw it begin to soar. Really, if you go back to 2008, maybe 400, 600. Then it jumps to 12. Wow, that was high. Then to 14. Then to 1900. Now, at that point, everyone, including myself, figured it's going to 2000. We were all wrong because that turned out to be the top. And for 3 years after that, it dropped to 1800 and had a definitive ceiling there, and then would trade between 1800 and 1537. I remember those numbers really, really well, only because every time it would hit 1500, boom. Every time it would hit 1800. Went there for 3 years until, guess what? Quantitative easing started to unwind. And once they what did they have? QE1, QE2, QE3 they called twist, which was they were swapping one time period of debt instruments for another and then tapering. Well, guess what? Then it broke through 1500, and then it went over a 5-year period. When you look at it from, say, 2013 to the end of 2015, beginning of 16, it hit 1,020. Now, that's a depressed price of gold.
Absolutely.
That's something you can go, God, it's halved itself. It was at almost 2,000. It's at 1,000. Now, that's a move down, and that's something that was serious. Now, if you're going to whine about it going from 2,000 to 1,800, get a grip. I mean, the bottom line is, that's why I say it's such an excellent point. The bottom line is, has it really moved down that much? No. So it's all relative.
Gotta ask you, like I was looking at the charts and I compared the GDXJ gold versus the Fed fund rate hikes in the last 10 years.
Right.
And in 2016, you just mentioned it, early 2016, we had a rate hike. And all of a sudden, like gold, the GDX exploded, gold shot up higher. Do you expect the same thing to happen now? Or is it just a completely different environment that we're in than we were in 2016? Or do the old chart patterns sort of apply here as well?
You know, I think we're in such a unique environment in terms of the root causes of what took gold to a new record high and what caused it to begin to sell off, that the old game plan is not going to be the same as the new game plan. Surprisingly enough, it's the fact that they stopped quantitative easing and we didn't really see the market break hard to the downside. They haven't really raised rates. And the question is going to become, we say that gold is an excellent hedge against inflation, but yet we're seeing them run to the US dollar. And prior to that, currencies as a whole, countries were having a race to zero. I mean, wasn't that kind of the talk a couple of years ago? Oh yeah, they're all devaluing their currencies. Now we're not really talking about that. And so I think that that's going to play an important role. Cash is king. The dollar is still considered to be on the throne, so to speak. And yields are beginning to become not acceptable, but, you know, when you were going to the typical person going to a bank and getting 0.2% on a savings account, it was ridiculous. Now it's 3%. And that's going to change things. The dynamics is going to be whether or not the root causes of inflation, meaning the supply chain bottlenecks, because that's really the grinding issue, the cost of food and the cost of oil, whether or not they work themselves out of the system, which has nothing to do with Fed action. If they do, we're going to have a soft landing. If they do not, the Fed can't pull off a soft landing. It's going to be a crash landing. It's not going to be a hard landing. And those are completely different components than what we faced in past recessions.
Interesting. Like I was keep trying to make comparables. And now I come back to March 2020, where everybody just dumped everything they could.
Right,
I was
right.
like, oh my goodness, the world is going under, and that's the end. It's going to stop turning, and that's the end of that, right? And look at the charts again. It looks a little bit like the gold price. People are dumping everything for cash right now. Do you see that? Like March 2020 was very temporary, like only a very short period of time. Do you think that changing anytime? Do you see that changing anytime soon, or do we have to deal with all of this, like the sentiment all through the summer right now? Or do you see a trigger that might change that again quickly? Because COVID quickly changed the narrative again. Like it was 2 weeks and then we were done with the worst, it feels like. Or it felt like.
We were on at least two occasions. You know, we had it and then you had the variants. What I find that's interesting right now is that the boycott on oil by the Western Alliance forced Russia to change the way they sold it. They only accept rubles and gold. So they've been accumulating gold. I think that the smart money and the smart countries are in an accumulation stage of gold. They know something we don't. And that's, gold's always going to have intrinsic value. That intrinsic value over time will always go up as long as we have fiat currencies. And that's at the root of this whole thing, is that prior to 71, there was some value to a currency. It was somehow, at least it was redeemable if you were a country, let's say, in gold bullion from the United States. It's no longer. And so with all currencies being virtually fiat, in my opinion, gold has got to have a consistent, not an acceleration, but a consistent growth in terms of value when weighed against fiat dollars. It might not be the same if you weigh it against cattle or against a commodity like grain or something, but against a fiat currency, where else can it go?
No, it's true. No. Gotta ask you, since I have you here, the goldforecast.com, obviously, you gotta make a gold forecast for me now till the end of the year. I'm gonna put you on the spot, Gary.
That's okay. I like being on the spot. It makes me think. but I have to qualify it.
Okay.
I'm a hybrid technician. In other words, I believe it's the fundamentals that cause price change. But I also believe that technical studies and indicators give you an idea of where it might go. Recently, the fundamentals have been so much more important than the technical indicators that the forecast that I'm going to give you is going to be based on technical studies. They have to be, because we're at near a record level. And how do you forecast how much higher will it go without some sort of math equation? I do believe that we are in the final stages of a major rally. The rally began in 2015 when gold bottomed at 1,020. I think that and I don't have a timeline, but I think that by the end of this year into next year, somewhere around there, it will work itself out to yet one more all-time price high. I'm looking at about 2120, maximum 2200. From there, I believe we'll go into a multi-year decline in price. And that decline in price might take us back to 1700. In other words, I don't see that we'll ever have an opportunity to buy it at 1200. But where is it going to go? I think we've got one more leg of the rally ahead of us. We could have more of a correction this current leg of it going down. I'm not convinced that it has terminated or concluded, but at some point it will. I believe that there's really strong support at 1,800, maybe even 1,760 or 90. I don't think it'll go there. And we'll have one more whoop-de-doo, one more big move to a new price high, and then we'll enter a multi-year correction. And that's based upon the fact that inflation will actually work itself out.
Fantastic. Gary, thank you so much for coming to the studio. It's great seeing you. Thanks for meeting in person. It's awesome.
Great
conversation. Really enjoyed it. And let's get back to the conference.
You got it.
Fantastic. Hold on. I got to do a quick outro. I got to say thanks to everybody. Thanks for tuning in. Thanks for watching SF Live. We were joined by Gary Wagner, thegoldforecast.com. Make sure to follow his website. Sign up. Newsletters on the website as well. Make sure to do that. And make sure to give this video a like. Smash that like button. And more investors will be able to see it. And it helps us tremendously. Thank you so much. And we'll be back with lots more content this week. Thank you.